Hey everyone, it's Imran. I'm back with another macro options spotlight for you. All right, so US indices giving back some initial gains. They obviously knee-jerked a bit higher on the fact that we got a debt ceiling deal over the weekend. Managed to close pretty much bang on unchanged on the S&P. Nasdaq still did eke out a little gain of 40 basis points. Same can't be said for other indices. So we had Russell down, Europe down, and China getting absolutely hammered, down 3% again. They've had some PMIs overnight, manufacturing and non-manufacturing, that came lower than expectations and at a year-to-date low on the manufacturing side. So that's got people spooked again. Gold did manage to hold on to some gains yesterday, but we have seen weakness in industrial metals and the energy sector getting pummeled again, with both oil and nat gas down around 4% apiece. Looking at the dollar, did remain firm. We went above 104, about 104.5 now on DXY. So this thing continues to build a little bit of momentum. Treasuries also firmed up a little bit. TLT's up 1%. Likely to be a bit of month-end buying there as well. And the fact that with the debt ceiling deal, you're taking a default off the table. So in theory, yields come down a little bit on the back of that. And we have seen short-end yields come down in the last couple of days as well. In sectors, we saw ARC outperforming again, up a couple of percent, whilst everything else was in the red. So tech clearly still remaining in favor. But remember, ARC really not having quite the same enthusiasm as anything that has some AI attached to it. Looking over at vols, equity vols were higher in NASDAQ over a vol point, and clearly FXI nearly 2 vol points. So those are the things that are finding the biggest vol bid. Outside of that, vols were relatively stable. Energy commodities saw a big pop in vol, around 3 to 4 vol points. But outside that, commodity vols not doing a whole lot. Bond vols pulled back, so you see those in red, to kind of counter to what we're seeing elsewhere. Bond vols had been rising last week, but as the default risk kind of comes down, we are seeing a bit of a pullback in vol there. And HYG vol is now on a low 7 handle, starting to look interesting maybe on the buy side, and looking at a carry down to 5%. So it is actually realizing kind of in line with what it's implying, whereas HYG has been in positive carry for quite a long time, starting to see that carry disappear as implieds come down to the lows. So maybe starting to look attractive to sniff out and maybe buy some HYG again. Also, staying on the HYG point, we did see skew lower as well, down to low percentile. So maybe picking up some HYG puts for those who want to get ahead of a potential credit sell-off later in the year, in sort of September or December. Maybe those sort of things are starting to look attractive again. Outside of that, skew pulling back in equities, particularly in the US equities. NASDAQ leading the way there. That's gone down to a pretty low percentile as the upside in NASDAQ gets repriced. And then in general, nothing too exciting to say on skew elsewhere. We did see nat gas skew and silver skew moving a little bit deeper into call premium there. But really, that's the only thing to call out. All right, that's the summary for today. Moving on, looking at some charts. So the recent explosion in NASDAQ has started to drive what we call the spot up, vol up dynamic. That's something that we've talked about before and can be observed in this uptick that we've seen in the VXN, which is basically the VIX of the NASDAQ. So in that last leg higher in the NASDAQ, we've seen a pop in VXN. Now, you often see this type of behavior when the rally's getting a little bit frantic and a little bit mania-like, bubble-like. So it's not really a sign of a healthy rally, and it's often a precursor to some kind of correction. So this AI mania has been driving this move, and we've obviously seen very narrow breadth to this rally. So these are all signs to us that maybe things are getting a bit exhausted here as we're seeing this vol up, spot up price action. Now, when we move over and compare it to like the tech sector in Hong Kong, so China tech, you see this is the ratio between the New York FANG index and the HS Tech Index, and it's just gone absolutely parabolic, right? So this is pretty violent divergence that we're seeing between. So all tech isn't equal, basically, right? So Chinese stocks have been imploding to an extent in the last month. PMIs in China disappointed overnight. We're continuing to see stress in the property sector. We're seeing yuan weakness. All these things are not great for China. Now, having said that, we mentioned China. We're talking about some mean reversion and tactical long plays yesterday. Now, Morgan Stanley are kind of echoing what we're saying. They're actually saying that generally when you see Chinese manufacturing PMIs tumble the way they have done, that's this blue line, and it gets, you know, below 50, usually that is met with some kind of easing from policymakers in China. Okay, and that easing tends to then be good for risk assets in China. Okay, so they're doubling down on their bullish case in China, and they are expecting that economy is going to improve, and the reopening dynamic is actually in play. But you know, maybe there's just a longer lag to that actually coming through. So they're doubling down. We do think tactical bullish plays to buy China here are starting to make sense. Not something we would do outright long and take a load of downside risk, but using optionality always, you know, keeping your losses limited. We think there's some value there. Similarly, we think fading this US tech kind of mania as well is starting to look interesting, whether you do it via put structures on the NASDAQ. I think Goldman's are out there pitching put spreads on the NASDAQ as a good way to fade this. Clearly, NVIDIA's gone parabolic. So if you wanted to do some sort of put condory type structures on NVIDIA, we think that's got some value as well. But we would always use options, okay? Fading these type of extreme moves does look great from a mean reversion perspective, and things look very stretched here, but you got to keep yourself safe. That's what we're all about here at Options Insight. Keep you guys safe, show you the opportunities, but show you how to not blow yourselves up at the same time, okay? That is the key. You need to live to fight another day when you're wrong, and you need to expect to be wrong regularly, okay? Anyway, moving on. Another opportunity that we're seeing, quite an interesting one. So Japan's been rallying really hard, obviously, since sort of March, April time. Again, you could argue somewhat parabolic in terms of the move that it's had. There has been some of the tech mania kind of in that move as well. But we are seeing multiple signs that this might be getting exhausted. Okay, so first of all, we always look for bearish momentum divergence. We have seen a higher high printed here. We've seen lower highs printed in the momentum indicator, our favorite momentum indicator, which is the composite indicator. This helps us identify divergence opportunities and signs of exhaustion. So we think that is one indicator that the Nikkei may be ready to roll over. Okay, then we've got fast money. So that our friends at Variant Perception, they put out incredible institutional grade research. Basically, they were kind enough to share some of their charts with us, and we see their fast money indicator showing there's been a rush into the Nikkei, and this is looking fairly elevated here. So pretty extreme, long, crowded positioning from the speculative players, the fast money crowd. So that obviously is a bit of a counter indicator as well. And then lastly, there's something that they do called LPPL, which is basically, I think it's the log power law. I can't remember exactly what it stands for, but basically they're quantitatively analyzing the price action, and they're finding that there's a bit of a bubble. They're trying to identify this bubble-like price action and trying to identify when it's getting exhausted. And they recently just flagged that they've detected a bubble in the Nikkei on the 26th of May. It's projected to end on the 31st of May, so that's today. And once that ends, they could see a decent 5 to 10% correction in the Nikkei over the next month. So that's kind of what they're calling for. We like the idea. We've got some trade ideas on the back of it, and we think it does make sense. The last time they came up with one of these signals on their LPPL model, it was on gold, and they pretty much called that very near the top in gold recently, up at 2070 or whatever it was. And you've seen gold go down to the low 1900s in short order. So this is quite a powerful signal, and definitely worth paying attention to. So then the question is, how do we play it? Let's look at our trusty Vol dashboard. This is our Options Insight Vol dashboard. Looking at this on the Nikkei, the strategy compass is showing us bearish risk reversals, kind of where we're landing. Why does that make sense? So we've got a medium level of vol. We've got kind of mid-range vol at 17. So you look at the range that this Nikkei vol trades in. We've obviously got very stretched price action, so near the top end of the Bollingers in terms of spot. Carry-wise, positive vol carry, so it's not a no-brainer to just outright be long puts if you wanted to fade this thing. So something a bit more vol theta neutral makes sense. And then look at the skew. Skew's been trending down for ages and is pretty much bang on its lows at around 1 vol. I mean, it did get close to 0, but it doesn't really ever stay there. But it's about 1.25 vols right now for puts, which is near the low end of the range that the skew normally trades. So all these factors to us are saying bearish risk reversals on the Nikkei are setting up very well if you want to fade this move and take advantage of this all these signs that we're seeing that the Nikkei move in the near term at least might be exhausted. That's not to say Japan doesn't keep rallying. Warren Buffett's buying it and he's holding it for a long time. This man thinks it's going a hell of a lot higher and it offers value on a global perspective. I'm not going to disagree with Warren Buffett. What I am going to say is that the recent parabolic price action looks like a fade, and we are finding smart ways to fade it using the options market. Thanks a lot again, everyone, for listening, and I'll catch you all tomorrow. Cheers.